Okay guys, so I got another amazing fintech company here for you today that's taking a massive beating. But today we're really going to be focusing on, has the performance of the actual company been doing as bad as the actual stock? We might actually see a potential, opportunity here for an oversold stock and that we could add to our portfolios. The company I'm referring to is StoneCo, ticker symbol STNE. Now, I'm not going to go over everything that they do in their business. That's not this type of video, okay? We're just going to be talking about the stock. What they really do, though, if you have no idea, they're very much like Square, where they deal with e-commerce, payment solutions, as well as digital banking solutions. Except the funniest thing is that the most polarizing two investors in our entire world, potentially Cathie Wood on the growth side and Warren Buffett on the value side, both own this company on their balance sheet. So today, let's find the secret sauce about this company to find out whether, it's a great deal like Warren Buffett thinks it is. So StoneCo IPO'd in October 2018, okay, for $31 a share. The second it IPO'd, just like Coinbase, it took a crash and halving its actual market value down to $17 a share. This was just in 2 months. In December of 2018, this is where Warren Buffett bought in at $18.44 a share. I know this is a lot of numbers, but obviously we'll try to keep it organized. Then after Warren Buffett bought $250 million worth of this company, the company just slowly started to run all the way up to $43 a share before the pandemic hit. Once that happened, it crashed all the way back down to $18 a share once again. Then everyone knows what happens during the pandemic, right? This thing skyrocketed to like $95 a share, which then, some things took a turn for the worse. The company didn't manage a couple things properly, a couple credit risks in the company as well, and we're going to go over those. But then the stock actually started crashing, okay? And now today, it's sitting around $17 a share. At one point, it was actually at $14 a share, way lower than what Warren Buffett was holding it at. I just want to preface before we actually talk about what they did this quarter, whenever I talk about the stock, okay, it's in US dollars. But whenever we actually talk about the revenues or any of the actual company details, it's going to be in the Brazilian real. It's worth about 1/5 of US dollars, but it's just good to keep in mind that the numbers you hear don't necessarily translate to, what the actual market cap or any of this is going to be. So starting with a little bit of a statistics overload, which usually happens with fintech companies. So the total payment volume for StoneCo's actual, financial and payment services was around 75 billion real. This was up 53.6% year over year. The total active payment client base actually went to 1.4 million users, up 210% year over year. Whenever we're talking about banking clients, it went to 423,000 members, up 400% year over year. On both the banking and the insurance side of the digital platform, their actual average revenue per user went up by a dramatic amount. And yet all of this growth, we actually saw customer acquisition costs go down 28% year over year. And payment net adds also added 310% year over year growths as well. Now that's on the payment and digital side. Whenever we look at their actual software solutions that are offered with their new acquisition of Links, you can see also another amazing growth rates. You look at consolidated software revenue was up 1,670% year over year, an additional 200,000, clients on their software side that they had never had before, an insane retention rate from the actual clients that we brought over from Links, and literally the list just goes on and on with this company. But I want to talk about what's actually wrong, because there's no way that a company just goes from $95 down to $14 if, the growth rates continue to skyrocket the way they're doing. Herein lies the problem of adjusted net income, okay? What we actually get to take home. In Q3 of 2021, we saw around 133 million real brought in for adjusted net income, which was actually down 54% from 288 million real just from 1 year ago. This is mainly due to two main reasons, okay? One being the fact that they actually bought into this company called Banco Inter. StoneCo invested around 2.5 billion real into this company, for which then year over year it actually crashed by a significant amount. About 1.4 billion actual real was lost on a mark-to-market basis on this company. Now we still hold every share that we've ever held of this company, just currently right now the market share of that company is down, which means that our investments are down. Another major factor, and it has to do with us actually expanding into a bigger bank, is just the fact that our margins have been getting cut down as we're bringing on new support systems, new services, new customers, but there is a good, silver lining to this is that the actual margin is getting a lot better. This means that we can get back to a sustainable take rate for the company and start actually making some more money, but in last quarter in Q2, which also was part of this crash. And now it's just not quite what it was back, in 2020, whenever we had like coronavirus and all these things that were boosting up our numbers dramatically. Now, here is where I actually lie differently than a lot of the other investors that are trying to invest in this company, okay? And that's the fact that they're trying to compare to last year's numbers. I don't want to compare to last year's numbers. I want to compare back to 2018, when Warren Buffett, one of the best capital allocators of all time, actually put in $250 million worth of his own money into this stock. So what has this company done since, Q3 of 2018, back when Warren Buffett bought? Well, they grew their client base by 690%, okay? They actually grew their revenue by 450%. They grew their total payment volumes by actual 440%. And they're evolving past actual e-commerce and getting into the actual banking industry, right? Before, back in 2018, there was no 422,000 members. There wasn't these 200,000 software clients, and this is really where they're starting to build a true moat, just like Square did whenever they started with e-commerce, and now they're building into the actual banking system. They're following the exact same footsteps. Well, for adjusted net income, the big problem that we're actually having today, which is just absolutely falling through the ground right now, even then, okay, whenever we look back at Q3 of 2018, which was 89.3 million real, to today when it's actually 132.7 million real, which is actually an increase of 48%, over the course of what is 2018. Yet the price of the stock is lower than what Warren Buffett bought it at. We have these insane triple-digit growths in client base, payment volumes, in revenue, and actually in net income as well, actually in 48%, right? But then that should be, considered in the actual price of the stock. Yet they still are crashing down like crazy below what he bought it at, what he thought was fair value for the company. But when it comes to the best venture capitalists in the entire world, whether that's Tiger Global, SoftBank, Sequoia Capital, or even Andreessen Horowitz, they all say that total addressable market is the number one thing that they look for in the companies that they want to own. It's the single most important metric whenever they look at a company, okay? Warren Buffett's no dummy to this either, neither is Cathie Wood. So I want to shift our attention over to Andreessen Horowitz's actual article that they wrote here, Latin America's Fintech Boom, okay? This is one of the companies that we just spoke about, and they're talking, this was actually written back in April of this year, just talking about the sheer opportunity in Latin America for big fintechs, just like StoneCo. I highlighted some areas to get through this article, although it is extremely long. So let's just go over the highlights really quickly. So one of them being that Nubank figured out early on what has since become obvious for the rest of the world. There is an enormous amount of untapped opportunity in Latin America for financial services of all types. Latin America is currently experiencing an explosion of fintech activity that is just starting to begin. This was just written a couple months ago, okay? Let's scroll down here really quickly. Latin America is large. They talk about a whole bunch of other countries, but this one I just wanted to highlight Brazil. Brazil has a population of 210 million with GDPs of around $1.8 trillion. That's US, by the way. That's US dollars. But anyway, building a company in Latin America provides an incredibly large addressable market to build better products and distribute them to vast number of eager new customers. They go on to say in this part of the paragraph, which we're going to skip ahead, but they talk about Mexico here, where only a small percentage of the actual population actually banks, digitally. And if you see here in Brazil, only about the top 5% of banks actually own about 80% of the people's money in the actual areas. This means that they don't have to spend money on innovating and lowering their margins and everything like this because, well, they already have everyone and there's no other options. This is where Nubank and StoneCo actually come in, right? There's a massive pent-up demand for customers who have historically been locked out of the financial system by incumbent financial institutions. Now, this is where you see Brazil and everything like this, top 5 banks like we spoke about. They go on to say just what I had just said, right, is that most banks in Latin America didn't have a mobile app and requiring an in-person banking for the majority of their users. Banks have long ignored tech-driven, mobile-first approaches. Now, this article goes on to say Latin America's economies still rely heavily on cash. For Brazil, it's around 70% of the amount of, money that's going through is in cash. Now, this isn't actually good for, the government. They would want to make it digital because then they can actually track how their taxes are being spent. Cash is very, very hard to track. Though e-commerce has seen a dramatic surge over the past year, Mexico, for example, seeing a 32% year-over-year increase in 2020. They don't actually give us numbers on Brazil, but these numbers seem to be very, very parallel, so you can kind of see a very, very close link to what has been seen in, Brazil. The default for most customers in Latin America is to order online, then pay at your local convenience store in cash. It's super, super old style, right? And I love this next part. Your margin is my opportunity. Latin America's banks are some of the most profitable in the world. This is exactly what I was talking about because they do not need to innovate, okay? The average return on equity amongst banks by county, you can see Mexico here actually being the top, but Brazil actually being a close second, and for the majority of the years actually being the highest margin company, that has existed. Whenever we compare this to a SoFi, another company that I love that's mainly based in the United States, the margins are not even comparable. The difference between a 9% margin versus a 17% margin is almost double. This is the super importance that we're talking about. Let's continue on here, but the status quo described above has remained largely unchanged for decades. I don't know why I didn't highlight this, but there's reasons to believe that changing customer experiences, widespread smartphone adoption, and loosening regulations are creating an opening for financial innovation. This is where StoneCo comes in. Mobile phone users in the millions from 2013 all the way, to 2018. Brazil, here's the top line, going at a massive growth rate. The same thing whenever you look at, mobile phone user penetration versus the population, another insanely, huge statistic, which is already met in the United States. So that innovation is already there. You don't have, the big players that we have today have been the big players, right? And so it's really, really hard to innovate on that. Being the company that actually gets people on, before they have smartphones is how you get companies like the size of PayPal, like growing before they even had these things. So now let's continue on. I think there's just one last thing here that I wanted to show you guys, the e-commerce share of retail in Brazil, okay? So you can see over the last 10 years getting to around 6%, okay? Then in 10 weeks, this is just 10 weeks. I wish they would show what 2021 is, what 2022 is going to look like. Well, obviously they don't know yet, but I'm sure the acceleration is going even faster because word of mouth is a big reason why people use this stuff. So before, whenever there was only 4.8 to 5.8% of people actually letting people know and going, hey, you need to get this app, you need to get StoneCo, you need to get all these things. Now you have 12.6%, which is probably, because, the pandemic just continued and continued, it's probably closer to something like 20s, in the 20%. We are almost 2 years into this pandemic. So just unbelievable what can happen in 10 weeks of an insanely pushed forward business. And this, back in 2018, is when Warren Buffett bought. I know I keep bringing it up, but you have to think about where we are today. It's triple where we are. And this is why the client base is growing so fast. It might even be way, way higher because our client base is almost close to 7 times or 6 times, right? And so if the client base is 6 times, but the actual, e-commerce growth and all these things are not quite there, that we could even see StoneCo even trying to convert some of the people that aren't even getting new phones, having people switch from their legacy banks over to them because it is a better service. Just skipping along here to the last point, okay? They just talk about how pen and paper solutions are being replaced by online and digital first solutions to issue invoices, manage bookkeeping, and accept payments, baby. That's what we're talking about. This is Andreessen Horowitz, okay? This is not some guy on Seeking Alpha or something like this. These are some of the smartest investors in the entire world, okay? We expect the trajectory for business services to be similar to what we saw in the United States over a decade ago. New localized products and companies are poised to take advantage of these dynamics. The business customer base in Latin America is large, growing, and has a high expectation for the modernization of banking. Boom. That's all you need to hear. That's all you need to hear. Warren Buffett bought in at a higher price than you at what was 1/6 of the customer base, okay? So that is just insane. Actually, I just wanted to say one more thing. I know I said I was done, but okay. To date, most companies to date have picked out a core market, Brazil, preferably a large one, yes, to set about proving that they can expand, usually making major changes to their business in the process to be able to cover many more of Latin America's countries, opening up financial access for customers and businesses alike. Okay, now this is super important because right now they're in Brazil and a lot of their costs are going into things like actual, increasing their actual business, customer service, all this stuff. It is going to cost some real money at first, but it is going to grow their business over time. And that's what they're trying to do. They're trying to plan for massive growth. And this is why institutional investors like Warren Buffett and Cathie Wood are loving this stock. I know I've been saying their names a lot, right? But there's actually a lot of people that own this company that are very well known, okay? So Insider Holdings, for example, the people that are actually responsible for this company own around 14.5%. That is massive, okay? Then add in the amount of institutional holdings at over 80.2% of this business. That leaves retail investors like you and me to have 5.17% of this business. That's the float on this company for you and I. That's just crazy, but and I know that there are problems in Brazil, right? Inflation's a real problem in Brazil. But the truth is, like, if any company at all should be inflation proof, it should be payment processing and digital banking companies. Because if you're processing through a certain amount of total payment volumes and you get paid on a percentage of that, and let's say inflation just doubles the amount of dollars, okay? Now you're just processing twice as much. Well, whenever that happens to the payment processing, we still take our same amount. So regardless of what inflation is, we should still be able to take our cut. Same thing with digital banking. Well, like, inflation's around 10%. So for digital banking, let's say you get a raise, okay, of 10% because, you have to combat inflation. You're spending that on your groceries and everything like this. Well, hopefully the spend on groceries goes back to us because that's the payment processor. And then, you're also getting a 10% raise. So then you're keeping that in your bank, which is also through StoneCo, which then, you're getting to keep a higher amount of assets under management that is also just going to pay us more. So inflation is a problem, but if any company is to be, immune to it, it is StoneCo. Now, just to talk about the actual company now, the market cap for this company in US dollars is around $5.2 billion, okay, at the time of recording this video. Cash in their debts is only off by $200 million. It's very, very close to just being dead even. And the forward PE ratio on this company is 12.5 times. Okay, so for a company that's growing this much, okay, to have a price to earnings ratio on a fintech like this is just absolutely astonishing. And there's really no funny business going on with this company either. Like I would have thought, with a company going from $95 down to $14, that there was going to be heavy dilution in the company, but it's not at all actually. The outstanding share history has stayed materially flat since IPO, right? There obviously is going to be a huge amount of outstanding shares go up whenever you do IPO. That's just the way it goes. But once that happens, they're actually not diluting at all. Just an absolutely insane company. I'd say like my price prediction for this company is probably like around $24 a share. That's what I think is a fair value for this company at its current state. I don't think it's going to go back to $95 and I'm fine with that. But you have to take in the fact that we are not even doing as bad as we were in 2018, let alone all the hundreds of percents that we're doing across the board. And then also the fact that we're also bringing up the average revenue per user on all of our clients. Okay, so yeah, we might be spending a lot to get those clients, but we have them now and we make more on them now. So if we stop advertising, we stop wanting to grow, that net income is going to go through the roof. Not to mention, we're already doing more than 2018 by, a 48%. So I can't see this stock going down anymore. And if it does, that could just be macroeconomic things in which I'm just going to buy more. Anyways, guys, if you liked the video, I'd really appreciate a like and subscribe down below if you want to see more financial content just like this. I really appreciate all your guys' support lately. This has been an amazing journey in the last year of doing this YouTube thing. And hope you guys are liking the videos. Tell me what you guys like to see next and I'll try to do that for you. But I got some pretty awesome videos coming out for the end of the year.